The year is 2006. Wall Street is riding high. Investment banks are posting record profits. Traders are buying million-dollar apartments like they're ordering lunch. And underneath it all, a time bomb is ticking. This is the story of how the smartest people in finance ignored every single warning sign before the greatest economic collapse since the Great Depression. This isn't just about greed. It's about willful blindness on a scale so massive it nearly destroyed the global economy. Let's go back to 2003. Housing prices are rising faster than they ever have in American history. Normally, this would be cause for concern. But on Wall Street, they see dollar signs. The system works like this. Banks give out mortgages. Then they bundle these mortgages together and sell them to investors as securities. It's called securitization, and it breaks the most fundamental rule of banking. Traditionally, if you gave someone a mortgage, you kept that loan on your books. If they defaulted, you lost money. This meant you actually cared about whether the borrower could pay you back. But now, the banks could sell the mortgages immediately. They collected their fees and passed all the risk to someone else. The incentive structure was completely backwards. Loan officers got paid for volume, not quality. The more mortgages they originated, the bigger their bonuses. Whether those borrowers could actually afford the homes became someone else's problem. Edward Gramlich, a Federal Reserve governor, started raising alarms about predatory lending in minority communities. He saw mortgage brokers targeting vulnerable borrowers with loans they couldn't possibly repay. He wanted the Fed to investigate. Alan Greenspan, the Fed chairman, refused. He believed the market would regulate itself. This was warning sign number one, and it was completely ignored. By 2004, the FBI publicly warned that there was an epidemic of mortgage fraud. They used those exact words, epidemic. They predicted it would cause a financial crisis. This wasn't some conspiracy theorist in a basement. This was the Federal Bureau of Investigation holding a press conference. Wall Street's response? Crickets. The mortgage machine kept churning. Meanwhile, a new product was taking over the market, subprime mortgages. These were loans given to people with poor credit, unstable income, or both. In the year 2000, subprime mortgages made up about 8% of all mortgages. By 2006, they were 20%. That's a $1 trillion market that barely existed 6 years earlier. And these weren't your grandfather's mortgages. These were exotic products with names like Ninja Loans, no income, no job, no assets. Borrowers didn't have to prove they could pay. They just had to sign on the dotted line. Some loans didn't even require a down payment. Even worse were the adjustable rate mortgages with teaser rates. A borrower might pay 2% interest for the first 2 years, then the rate would jump to 8% or 9%. The monthly payment could double or triple overnight. Mortgage brokers sold these by telling borrowers not to worry. They could just refinance before the rate adjusted. Or better yet, sell the house for a profit because prices only go up, right? Economists started noticing something disturbing. Home prices had always tracked with incomes and rents. It's simple logic. People can only pay what they can afford. But now prices were disconnecting from reality. In some markets, homes cost 10 or 12 times the median household income. Historically, that ratio was around 3 or 4. Robert Shiller, the Yale economist who predicted the dot-com bubble, published research showing housing prices were in bubble territory. He appeared on news shows. He gave speeches. He literally wrote a book called Irrational Exuberance, with a whole section on housing. Wall Street didn't care. They had sophisticated models that proved everything was fine. Here's where it gets truly insane. The investment banks weren't just selling these mortgage securities. They were using something called collateralized debt obligations, or CDOs. This is where the magic really happened. A CDO worked like this. Take a bunch of mortgages, some good, some terrible, bundle them together. Then slice that bundle into different layers, called tranches. The top layer gets paid first and is supposedly super safe. The bottom layer gets paid last and absorbs all the losses. That bottom layer is obviously risky, but here's the trick. Even though the bottom tranches were filled with subprime garbage, the rating agencies, Moody's, Standard & Poor's, Fitch, gave the top tranches auto-A ratings. That's the same rating as U.S. Treasury bonds, the safest investment in the world. Why would the rating agencies do this? Because the banks paid them. The rating agencies made money every time they rated a CDO. If they gave honest ratings, the banks would take their business elsewhere. The whole thing was a conflict of interest so obvious, it would be funny if it hadn't destroyed millions of lives. And Wall Street knew it. Internal emails later revealed that employees at the rating agencies joked about how they'd rate deals they didn't understand. One email said they could rate a deal structured by cows, and it would still get business. Some people saw through it. In 2005, a man named Mike Burry, who ran a small hedge fund, started reading the actual mortgage documents inside these securities. What he found shocked him. Borrowers with no income buying $500,000 homes. Mortgages where the monthly payment didn't even cover the interest. Loans given to people who were already behind on their credit cards. Burry did something crazy. He started betting against the housing market. He bought credit default swaps, which were essentially insurance policies that paid off if mortgages defaulted. The banks laughed at him. They happily sold him these swaps because they thought he was an idiot. Free money, they figured. Other investors started catching on. Greg Lippmann at Deutsche Bank saw the same thing. Steve Eisman, another hedge fund manager, visited mortgage lenders in Florida and couldn't believe what he saw. The entire industry was a fraud. They tried to warn people. They really did. Eisman gave presentations showing the terrible quality of the underlying mortgages. Investors thought he was crazy. Housing prices don't go down, they said. Not nationally. It's never happened. Meanwhile, inside the investment banks, risk managers were starting to panic. At Lehman Brothers, a risk officer named Matthew Lee raised concerns about the firm's accounting practices and exposure to toxic mortgages. At Citigroup, risk managers warned executives that the bank was taking on too much mortgage-related risk. These warnings went nowhere. The traders were making too much money. In 2006, Goldman Sachs employees took home an average of $622,000 each. The top executives made tens of millions. The CEO of Lehman Brothers, Dick Fuld, made $484 million between 2000 and 2007. Why would they stop? Every quarter, profits went up. Stock prices climbed. Bonuses got bigger. Yes, there was risk, but the music was still playing. And as Chuck Prince, the CEO of Citigroup, famously said, as long as the music is playing, you've got to get up and dance. The delusion went right to the top. Ben Bernanke became Fed chairman in 2006. In congressional testimony, he said that problems in the subprime market appeared likely to be contained. The Treasury Secretary, Hank Paulson, said the housing correction would be orderly. They weren't lying. They actually believed it. This is what makes it so terrifying. The people in charge of the financial system had convinced themselves that sophisticated financial engineering had eliminated risk. They thought they'd figured out how to keep the party going forever. By early 2007, the cracks were showing. Subprime lenders started going bankrupt. A company called New Century Financial, one of the biggest subprime lenders, collapsed in April. That should have been the wake-up call. Wall Street hit the snooze button. Most analysts said it was contained to a few bad actors. The overall housing market was still strong, they insisted. Just a minor correction. Then in June 2007, two hedge funds at Bear Stearns that were heavily invested in mortgage securities imploded. They lost nearly everything. Bear Stearns had to bail them out with billions of dollars. Still, the major investment banks insisted everything was fine. They kept buying mortgages. They kept creating CDOs. Some banks even created CDOs made up of other CDOs, CDOs squared. It was madness built on top of madness. Here's the most infuriating part. Some banks started secretly betting against the very securities they were selling to clients. Goldman Sachs was creating CDOs, selling them to investors, and simultaneously shorting them, betting they would fail. They were selling products they knew were garbage while protecting themselves from the downside. When this came out later, it was devastating. Goldman executives testified before Congress and swore they were just making markets. But the emails told a different story. Internal Goldman emails showed traders calling their own products junk and crap. The summer of 2007 brought more chaos. The commercial paper market froze. Banks suddenly refused to lend to each other overnight because nobody knew who was holding toxic mortgages. The European Central Bank had to inject $130 billion into the banking system to keep it functioning. In August, the CEO of Countrywide Financial, the largest mortgage lender in America, said the housing market was experiencing an unprecedented disruption. By September, there were lines outside Northern Rock, a British bank, as depositors tried to withdraw their money. It was the first bank run in Britain in 140 years. And still, Wall Street insisted the fundamentals were strong. By early 2008, the dominoes were falling faster. Bear Stearns, one of the oldest and most respected investment banks on Wall Street, was on the brink of collapse. In March, the Fed orchestrated a shotgun wedding with J.P. Morgan Chase to prevent Bear Stearns from failing. The bank sold for $2 a share. A year earlier, it traded at $170. This should have been the moment everyone woke up. If Bear Stearns could fail, anyone could fail. But the other banks insisted they were different. They were better managed. They weren't as exposed. It was all lies. Lehman Brothers would be next, then Merrill Lynch, then AIG, then everyone. The entire system was rotten. And the people running these institutions either didn't know or didn't care enough to stop it. The most damning evidence came later when investigators combed through the wreckage. The Financial Crisis Inquiry Commission found that the crisis was avoidable. They concluded that it was caused by widespread failures in regulation, corporate governance, and risk management. In other words, people ignored warnings, bent rules, and prioritized short-term profits over long-term stability. So why did Wall Street ignore every warning? The answer is simpler and more depressing than you might think. The incentives were all wrong. Executives got paid based on short-term profits. If the crash happened after they collected their bonuses, that was someone else's problem. The ratings agencies got paid to give good ratings. The mortgage brokers got paid to close loans. Everyone was making money, and nobody wanted to be the person who stopped the party. This is the terrifying truth about the 2008 crisis. It wasn't that nobody saw it coming. People saw it. They warned about it. They screamed from the rooftops. But in a system where everyone profits from the bubble, there's no incentive to pop it, and here's what should keep you up at night. We never really fixed the underlying problems. The banks are bigger now than they were in 2008. The too big to fail problem got worse, not better. And the same incentive structures that caused the crisis are still largely in place. Wall Street didn't learn to listen to warnings. They learned they'd get bailed out.